So I want you to picture this. Picture a developer, right? And they're sinking, I don't know, maybe $2 million into this massive, luxurious rooftop golf simulator.
Oh, yeah. Complete with the custom turf.
Exactly. The custom turf, the mahogany bar, you've got these sweeping panoramic city views. But then picture that exact same simulator just sitting there, dark and completely unused, for like 28 days out of the month.
Right. Which happens all the time.
It does. And then contrast that multi-million-dollar setup with a humble, maybe 800 square foot corner store down on the ground floor selling, paper towels and cold brew. And that tiny space ends up generating a way higher return on investment than the entire rooftop combined.
Yeah, I mean, what we're really looking at here is the trailing end of this modern amenity arms race. For the last decade or so, the real estate industry just prioritized spaces that were designed to look incredible in a glossy leasing brochure, or an Instagram reel.
Oh, absolutely. Like you're touring as a prospective resident and you see that brochure and you start doing the mental math like, oh, I'll be hosting these lavish rooftop parties every single weekend.
Right, you're buying into a fantasy.
Exactly.
Right.
But then reality sets in. The whole new apartment smell wears off. It's a random Tuesday night. You don't want to host a party. You just want to grab a snack and watch a movie.
Yeah, because we build these monuments to leisure, but daily life is, well, it consists of maintenance, not leisure. And that misalignment, it's really starting to show up in the actual financial performance of these assets.
Which perfectly sets the mission for today's deep dive. We are finding out what kind of amenities actually perform, meaning, what drives verifiable, real resident engagement, and how does that engagement act as a shield for a developer's bottom line?
And the sources we have for this are just particularly strong today. We're looking at 2 analyses from Steve McKinley, and he's drawing directly on operations at Urban Value Corner Store. So he brings in this raw, aggregated data from actual resident reviews, and then he pairs it with the macroeconomic realities of property management right now.
Okay, let's unpack this, because starting with the human element is so important. Before we even dig into cap rates and asset valuation, we need to look at what residents are publicly broadcasting about their living conditions.
Definitely.
And the sources highlight something just highly, highly unusual. So Urban Value operates these convenience retail spots directly inside high-density residential buildings, right? And across just 9 of their Dallas-Fort Worth locations, they've somehow pulled in over 3,000 Google reviews.
What's fascinating here is the sheer density of that feedback when you map it against standard residential behavior. Because think about it, the bar for generating unprompted, positive public feedback in multifamily real estate, it is astronomically high.
Oh, it's impossible. People only leave reviews when they're mad about a broken elevator.
Exactly. I mean, residents might really appreciate a resort-style infinity pool, but they are not logging on to a platform to write a 5-star review about the water temperature on a Saturday.
No, never. And to give that 3,000 number some context, across 9 locations, that averages out to about 335 reviews per site. And I was looking at the breakdown. A few of their flagship locations are just crushing that.
Oh, yeah. The numbers at the top end are wild.
Like Parkside Craig Ranch is sitting at 576 reviews. Mosaic Dallas has 507, Carolyn Las Colinas is at 466, and Legacy West has 436.
Wow.
That is the kind of digital footprint you would expect from a super trendy, heavily marketed local restaurant that sees thousands of distinct customers every single week. But these stores are generating that volume from a closed loop. It's just the same few hundred people living upstairs.
Right, which really forces us to look at the underlying psychology of what's happening, because residents aren't reviewing a bag of chips. They're validating the removal of friction from their day. These reviews represent thousands of these isolated kind of normal life moments where a resident felt a spike of relief strong enough that they actually wanted to document it.
Yeah, it really comes down to the frequency of use. I actually like to think of traditional luxury amenities, the massive screening rooms, the demonstration kitchens, as a tailored tuxedo.
Okay, I like that.
Right, because they cost an absolute fortune to build. They make you feel incredibly sophisticated when you put them on or use them, and they signal a lot of status.
Yeah.
But you wear a tuxedo maybe twice a year for a highly orchestrated event.
Right, if you're lucky.
Exactly.
Yeah.
But an in-building convenience store, that is your favorite pair of jeans.
And the jeans get worn 4 days a week.
Yes. You rely on them constantly. They're just totally embedded in your default routine.
Yeah.
You don't necessarily take photos of yourself in them to impress your friends online, but if they suddenly vanish from your closet, your daily life would be measurably worse.
That's a great way to put it. Because daily recurring utility creates structural loyalty. That is the core finding that McKinley outlines in the sources. The utility isn't glamorous at all.
Not even a little bit.
No, it's realizing you're completely out of dish soap while the sink is full, or it's 11:00 p.m., you're studying or working late, and you desperately need a caffeine hit, but you refuse to lose 20 minutes driving to a gas station.
But let's look at why a developer cares so much about that resident's late-night caffeine run.
Yeah.
Because it's not out of the goodness of their hearts.
No, absolutely not.
This shift toward these highly functional amenities is a direct response to a really brutal macroeconomic squeeze that's happening right now.
Yeah, the multifamily sector is facing intense margin compression. I mean, we are in an environment right now with elevated interest rates, which obviously drives up the cost of debt. Property insurance premiums have completely skyrocketed, especially in major Sunbelt markets. Property taxes are adjusting upward based on those peak valuations from just a few years ago. So operating expenses are basically surging across the board.
While at the exact same time, top-line revenue is totally under attack, we are seeing this massive influx of new supply. A record number of units are delivering, which floods the market, and suddenly renters have all the negotiating power.
Exactly. The days of easily pushing rents by, 8 or 10% at renewal, those are largely over in a lot of metros. So to keep units occupied, management companies are deploying heavy concessions.
Like giving away a month of free rent.
Sometimes 6 weeks of free rent. Or waiving parking fees, pet fees, honestly, anything just to get a signature on a lease.
Which obviously just bleeds net operating income. And for anyone tracking the commercial space, NOI isn't just like the cash left over at the end of the year. It literally determines the ultimate value of the building itself.
Yeah, let's put a lens on that for a second, because the multiplier effect is severe. Commercial real estate is valued based on capitalization rates, or cap rates.
Right.
So if a building operates in a market with a, say, 5% cap rate, every single dollar of net operating income you lose actually reduces the asset's value by $20.
Wow. 20 to 1.
Yeah, so an operational inefficiency doesn't just cost you a little cash flow today, it destroys equity when it comes time to refinance or, sell the property down the line.
So what does this all mean? Basically means the single most expensive event in a building's entire life cycle is a resident deciding to move out.
Oh, absolutely. Turnover is a financial sinkhole.
And the sources lay out the compounding math of a vacancy so clearly. First, you lose the rental income for the 20 or 30 days the unit just sits there empty. Then you have the marketing spend required to acquire a brand new lead in a hyper-competitive market. And then you have the sheer operational drag. The management team has to process the move out. They're coordinating vendors to turn the unit, conducting tours, screening new applicants. The soft costs of staff time alone are just enormous.
Which is exactly why retention is the ultimate operational strategy. Keeping an existing resident is exponentially cheaper than trying to source a new one. But the thing is, residents in these Class A and Class B buildings are discerning. They're evaluating their lease renewals based on the overall ease of their lifestyle.
And this connects directly to a concept from the sources that honestly fundamentally reframes urban design for me. McKinley talks about this redefinition of walkability, because usually walkability is just a geographic metric, right?
Right, like a score on a website.
Exactly. We look at a map and say, okay, the grocery store is a quarter-mile down a paved, well-lit sidewalk. Therefore, this building is walkable.
Yeah, but that's the traditional urban planning metric. Human behavior actually operates on cognitive load, not just physical distance. And that's where McKinley introduces this concept of solved moment.
Solve those moments.
Yeah. Walkability, from the resident's perspective, is really the time elapsed between a need arising and that need being fulfilled without starting a car or crossing an intersection.
So a solved moment is basically stepping off the elevator in your slippers, grabbing a carton of eggs, and being back in your kitchen in under 3 minutes.
Precisely. Because the geographic walk to the neighborhood grocery store, that might be lovely on a sunny Saturday afternoon.
Sure.
But on a rainy Tuesday morning when you're running late for a meeting, that exact same walk is massive friction. So integrating the solution right into the building's footprint converts an external chore into an internal amenity.
Okay, but wait. I'm stuck on the logistics here.
Yeah.
Because I'm playing devil's advocate. If this is such an incredible retention tool, why hasn't everyone done it? Why are we only seeing this model aggressively scale right now?
It's a fair question.
Because property managers are notoriously overworked, right?
Mm.
Running a 300-unit building is chaotic enough without asking the leasing agents to suddenly manage cashier shifts, deal with point-of-sale systems, and, figure out the supply chain for dairy product.
Well, that assumption, the idea that retail automatically creates an operational nightmare for the building staff, that is the historical barrier. But the breakthrough that's outlined in the sources is the decoupling of the amenity from the property's management team.
Oh, okay.
The modern model is strictly operationally light.
Meaning the property management company provides the square footage, but they don't actually run the store at all.
They don't touch it. A specialized operator, like Urban Value, actually takes the commercial lease. They hold the inventory risk, they manage the supply chain, they handle the staffing, the merchandising, the local compliance, all of it.
Wow.
For the developer, it acts just like any other commercial tenant, except this specific tenant actively enhances the residential value of all the floors above it.
Which completely solves the staffing headache for massive, high-density properties. And the sources actually mention two distinct formats for this. The first is that full-service Urban Value corner store. This is, the staff's curated experience acting as a vibrant neighborhood anchor.
Right, usually heavily integrated right into the lobby or the main thoroughfare of a large urban mid-rise.
And the staff there provides a real human element. They learn resident preferences, they tailor the inventory to the specific demographic of the building.
Yeah, but then the source pivots to mid-sized communities. Because if you have, say, a 200-unit suburban garden-style complex, the foot traffic simply doesn't support a fully staffed retail operation with cashiers. The math just breaks down.
Yeah, you can't pay someone to stand there for 3 customers a day.
Exactly. And that dynamic is what birthed the second format, the smart store coolers. This is where the integration of technology completely changes the scaling potential of the whole amenity.
So let's break down the actual mechanism of those smart stores, because the tech totally solves the density problem. We aren't talking about a traditional vending machine where your bag of pretzels gets stuck on a metal coil.
Oh, far from it. These are autonomous, right-sized retail footprints running on advanced telemetry and sensor networks.
It sounds like sci-fi.
It does. But from a user experience standpoint, it's so simple. A resident walks up, they scan an app or tap a payment card to unlock the door of the cooler or the micromarket.
And the system uses computer vision and weight sensors on the shelves to track exactly what the resident removes, right?
Yep. The resident simply takes the items they want and walks away.
No scanning barcodes?
No scanning at all.
Yeah.
The system automatically reconciles the basket and charges the account. There is zero checkout friction.
That's wild, and because the telemetry is live, the operator knows the exact inventory levels of every single smart store across their entire portfolio in real time.
Which optimizes the supply chain perfectly. Delivery drivers only dispatch to restock specific locations with exactly what was sold.
Oh, that makes sense.
Yeah, the building management team never has to call someone to say, hey, the cooler is out of sparkling water. The system already logged the transaction and scheduled the replenishment.
It also means the merchandising becomes highly adaptive. The data might show that residents in Building A buy energy drinks and protein bars at 5:30 in the morning, while residents in Building B tend to buy frozen meals and ice cream at 9:00 p.m.
Right, it's hyper-localized.
Exactly. The inventory naturally evolves to match the microculture of that specific building without anyone having to manually guess what the residents actually want.
If we connect this to the bigger picture, the entire philosophy of real estate development is shifting from spatial volume to functional efficiency.
Wow. Say that again.
We are moving past the era of allocating 5,000 square feet to an amenity space just to impress a lender. Developers are waking up to the fact that protecting a resident's time is the highest value proposition they can offer.
Because time is the ultimate unrenewable resource. An amenity that genuinely protects time essentially underwrites itself. It pays for itself by keeping those units occupied.
Because when it comes time for a resident to sign that renewal offer, they are doing a subconscious calculation of switching costs. And it's not just the financial cost of hiring movers.
No, nobody wants to pack boxes.
Right, but it's also the cognitive cost of leaving an ecosystem that has systematically removed the tiny abrasive frictions from their daily routine.
So the flashiest amenities might secure the initial tour, but the functional amenities are what secure the renewal.
Yes. The premise of McKinley's analysis is proven true in the marketplace. Convenience is the amenity. It transcends novelty.
Which brings us to you, the listener. I really want you to evaluate your own living environment through this exact lens of friction. Look at the minor logistical annoyances of your week. That last-minute realization you are completely out of coffee.
Or the need to grab a quick lunch when you only have 15 minutes between remote meetings.
Exactly. Calculate the actual time you spend starting a car, navigating traffic, finding parking, and standing in line just to acquire basic, everyday essentials.
It adds up fast.
It really does. So what kind of premium would you place on a living situation that simply evaporated those chores? If your environment functioned as a seamless support system rather than just a place to sleep, how much more anchored would you feel to that specific address?
The data suggests the anchor is remarkably strong. It changes the dynamic from a simple transactional lease to a fully integrated lifestyle.
Here's where it gets really interesting. If hyperlocal autonomous micro-retail is the ultimate tool for retention in multifamily housing, its application shouldn't stop at the apartment lobby.
Definitely not.
Think about the broader landscape of how we zone and build our environments.
Because the solved moments philosophy is totally sector agnostic.
Exactly. Consider sprawling corporate office parks. For decades, we've built these massive commercial campuses surrounded by oceans of parking, basically forcing employees to drive 10 minutes just to find a decent sandwich shop. Or look at massive suburban subdivisions, these master-planned communities, where single-family homes are geographically isolated from all commercial zoning, making a car mandatory for even the smallest transaction.
The blueprint we've analyzed today, this operationally light, tech-enabled, hyper-local convenience, it could completely bypass traditional zoning limitations.
Yes.
We could see the resurrection of the true neighborhood corner store, but modernized and embedded directly into the infrastructure of suburban cul-de-sacs and corporate plazas.
We really might be watching the end of strictly compartmentalized living. The realization that separating where we live from what we need is just an outdated model. Because whether you are leasing a high-rise apartment, buying a house in the suburbs, or commuting to a corporate campus, everyone is looking for an environment that just fits. A system that actively supports your day, removes the friction, and finally gives you your time back.